Well, today on Money Match, we're going to be talking to Dan Rohinton. Dan is a portfolio manager with Industrial Alliance Global Asset Management. He is somebody who is fascinating to talk to, and I'm really looking forward to our conversation today. Join me today on Money Match. Hey, welcome back to Money Match. It's Ian Ardill here. We're joined together today with Dan Rohinton. Dan, welcome to the show.
Hey, how's it going? Good.
Dan, you are not just a nice looking guy, but you're the vice president and portfolio manager of IA Global Asset Management. That's a mouthful, but for somebody who doesn't know what the heck that means, who are you? What do you do for a living?
So, what's interesting? It's really a job where you learn every single day. So, every single day I wake up, I look across industries all around the world, and our job is to build diversified core portfolios for clients that it's understandable, our process, we can explain it to you in plain language, but we do some sophisticated work on the back end to make the returns happen for your portfolios.
Amazing. So really what you're telling me is you're the guy and your team, you're leading a team of individuals in terms of asset deployment and investment choices from a day-to-day perspective.
Yeah, and our whole team, it's over $120 billion. It's 250 people as a whole, and we have a smaller group of individuals where we're a little bit closer to the direct money that we manage for you and your clients.
Wow. So Dan, I'm wondering if we can take a step back and kind of ask the question, who is Dan? Outside of your job title and your functionality, and we're going to dive into that in a few minutes, but tell me a little bit about who you are. What's your background?
So, what's interesting, Ian? I'm actually a pretty big nerd. So there was a time back in the day when I used to follow basketball. I used to play sports. I used to do all the usual stuff you do when you're growing up. But ever since I was a kid, I used to actually watch the news with my parents at 6 o'clock at night. And there's always one part of the news show. There's a local, some puppies saved from the tree, or there's a fire somewhere. But what always got me was the Toronto Stock Exchange and seeing the stock market indexes from when I was really young. So years of following that then led to actually reading the newspaper and then getting a job in accounting and finance and just staying steeped in all of this. And then I'm a child of the global financial crisis. So seeing it live, seeing it viscerally, seeing how the world changed, and then seeing COVID in my professional career even further, it really is, I've been defined by the markets from a very young age. And what used to be a basketball hobby became politics and reading about the news, to the point where I can't even tell you what teams are playing, who's in what league anymore, any of that stuff. It's all politics, news, finance, and investing these days. I've got a young family too, and we do a lot of extracurriculars now, but my job is really my life and my passion, because it's a hobby I get paid for.
I love it. It's interesting, even though for me, this was a second career choice for me in terms of I had a career previous and now jumping into this career. As a kid, growing up in a financial advisor's home, I remember hearing money chatted about, and one of my favorite things to do was run downstairs, open the Globe and Mail, and go through the market section and looking at the movement of the different unit values and going, oh, cool. Because I was able, I was buying at an early age. It was I certainly can attest to the experience and the thrill of being involved in investment.
Yeah. The world's always changing, right? There's always a new day. It's a chance to really walk into the world with a blank piece of paper every single day and know that your job isn't monotonous, repetitive, or anything like that. There's so much that's always going on. And what was orthodoxy 5 years ago, or let alone 10 months ago, is completely different today. And I feel like that happens over and over again. And it's such a rewarding thing in what we do.
So, you didn't just show up one day and say, "Oh, okay, I want to be a portfolio manager." Talk to me a little bit about your background. Like, we're in your living room. You're a kid watching the 6 o'clock news, and now there's an expanse there where now you're leading a team of 100 people deep, and you're trying to really capture the essence of the market. Talk to me about what that journey was for you to get to where you are today.
So the journey really starts in university. I was in accounting. That was my main profession because you're told, let's go become an accountant. Everyone wants, that's a great job. And then I realized auditing really wasn't for me. And at the same time, I got an internship at a Scotia Capital Markets. And then that led to a job at a small hedge fund, which then led to a job in New York. So I was actually across the street from Times Square. So you know where that New Year's ball drops?
Yeah,
Our
yeah,
offices
yeah.
was across the street there. So worked in Wall Street for a little bit, and then worked at a decade at CI, and then basically grew into the role of a portfolio manager during my time there. And I've been with IA for the better part of just over 3 years now, and it's been quite a rewarding experience getting to see clients at the same time as knowing and meeting the people whose money you manage and explaining to them just how the world really works, what's shaping our future, and how we put money to work for them.
So, just in a snapshot, and I know I'm making it really simple terms, you manage a couple of different funds, or you're the lead portfolio manager on a number of funds at Industrial Alliance. Can you just name them for the sake of our listeners?
Yeah, the flagship fund we have is IA Global Dividend, which is our most diversified core global equity portfolio. Then we manage a US dividend fund. And the way I would think about that is it's a bit more tech, it's a bit more growth oriented than global dividend. And then Canadian dividend growth, which is the Canadian dividend focused portfolio where it's primarily Canadian stocks. And Canadian stocks tend to be more value and a bit more yieldy versus the US index, which tends to be a lot more growthy for a lot less income. So I think of the global dividend as the middle, and then the two flavors in either direction.
And what's really exciting for me from an advisory standpoint is we actually we for our clients we have 5 different risk categories where we build out portfolios for clients, and we actually use all 3 of those funds interspersed into our different holdings. So it's an honor and a privilege to be able to chat with you a little bit more in depth today. But I'm wondering, on that vein, I'm wondering if you can let us see a little bit under the hood, into your brain a little bit, about how do you value stocks, or how do you look at a company and say, wow, this is a company I want to be involved with? What drives you to that decision making and going, yeah, this is a company we want to hold on to?
Yeah, no, 100%. And one thing I'd maybe just to set the table on the conversation is the last thing we do is read the newspaper, which is ironic given my time from back in the day when I would compulsively read it. As a portfolio manager, our job is not to read the news today, it's to predict what's going to be in the newspapers 5 years from now. So my job is to have a probabilistic view of the world as we look ahead and see if that's priced into the stock market. And the way that we specifically do that type of work is we don't look at an industry, say, take an Apple or a General Motors. We don't look at it in isolation. We look at every single piece before it gets to Apple. So the fabrication facilities in Taiwan for the chips that Apple uses, all the way to the silicone companies that sell into Taiwan Semiconductor. Then you finally get to Apple, and then you go to the Apple distribution points, and then ultimately their competitor sets. And we ask ourselves, Ian, a very simple question. Who has the right to make more money in the future than they do today? And how defensible is their ability to make more money? In the case of Apple, it's actually a simple question or a simple answer. It's really Apple for the most, for all intents and purposes, because they take most of the profits in the whole value chain. But sometimes it's a bit more complicated. If you're a General Motors doesn't really make a lot of money through the cycle. So you don't really want to own that type of stock. So what we do when we look at a company is we look at the future, do our best to predict it. And how we do that is by looking at those profit pools and saying, yes, this will be bigger 5 years from now, and the market isn't getting this right. Or, uh-oh, it's going to get a lot worse. Let's take a timeout from this stock. We're not interested because we just want to build 40 stock diversified portfolios. We don't need to own everything in the entire world.
Interesting. So, like for instance, in your global, dividend portfolio, how many holdings would you have at one time?
We tend to go between 30 and 40, but the real answer is closer to 40. So 38, 39, 40 tends to be the range. And you want to find the right balance between looking purely just like the index and being too concentrated. Because there is such a thing as being too concentrated because you don't want one stock to define your portfolio. Just what's that saying? There's only one free lunch in markets, which is diversification. And I think we want to stay true to that. So we want to have conviction, but we don't want to go overboard with that either.
So, so somebody who makes a deployment, if they own it, say, I don't know, like say they bought it 2 years ago and then they have it today, chances are they don't hold the exact same stock positions anymore, right? I think one of the things that makes you different, Dan, from say other fund managers is it's not a static hold. I think what makes IA or Industrial Alliance and what makes you unique is that you are definitely what's called an active manager. I'm wondering if you can describe that for me and what that means.
Yeah, for sure. And really, when you think about the market, there's passive, which is rules based, where you say the biggest market cap, the most valuable company in the world is number one. It's a 4% weight in the portfolio. The next one, and so on and so forth, all the way down to the 1500th biggest company in the world. So it's very formulaic, and that's known as passive. Active managers, our job is to look at the world with a clean sheet of paper and ask ourselves the question: how could we build the most diversified portfolio? Sometimes, Ian, it can be, we're not shy to say we're happy to own Microsoft. We're happy to own companies like an NVIDIA if it makes sense in the context of the portfolio. So we are not beholden to the stock market indexes, but we take what we can and take the best of what we can bring together. And I think that's very important when we look at the world today is the markets that we see are not static anymore. What's that saying with global warming? We're getting a once in a 200-year storm every 20 years. I feel like we're seeing that with the market as well. So I think it's important to be nimble, thoughtful, and more important than anything, in a dynamic, ever-changing world, be level, cool-headed, and neutral in your decision making.
So you don't get really excited about things? I'm just kidding.
Steady hands, baby, steady hands. That's all we got to do.
I love it. I love it. So I'm wondering if you can like I've heard you talk on BNN, and I'm sure people can talk, like Google your name and see some of this material themselves. But I'm wondering, for the sake of our listeners today, can you just talk to me about your methodical approach? You have a very systematic approach to understanding things, and you've talked a little bit about it in terms of the chain, but like, why would you get excited? I'll give an example. I heard you on an interview talking about garbage and why you would rather invest in garbage management as opposed to an alternative. Talk to me about that. Like, what drives some of your decision making?
Yeah, and it's important to say we're not just fans of garbage as a whole, but the reason garbage makes sense in a portfolio is garbage is consistent. So when you think about there's companies that are higher risk, more growth oriented, that have more volatility to it, right? You want to balance that out and always keep an even keel. And garbage is beautiful for that, because the beauty of garbage is we're always generating more of it. It keeps growing on a consistent rate. So a Waste Connections or a Republic or a GFL, they're growing their revenues effectively 5-6% per year, because even though volumes might be a little bit volatile, they're always taking prices. So it's route density, it's local. It's once you dominate a neighborhood, it's very hard to dislodge the local garbage provider. And then there's so many of these little mom and pop industries. So the beauty about owning a big company that's going to get bigger is you can buy out your local competitors. Like I'll give an example just now. There's a company called Miller Waste Systems in my part of the Greater Toronto area. And it's inevitable that one of the big guys is going to buy them. So every time there's a family change or some type of life event that puts up one of these businesses for sale, Waste Connections is there with a big check in hand saying, we'd like to take your business off your hands, and or you can join us through stock. So you have growth organically just through more garbage being created in the world. You have pricing power on top of that, and you have the ability to buy mom and pop businesses that were built from 50, 100 years ago at attractive valuations. So you have, in some ways, secular growth and consistency. So is it a high growth business? No. But this is why it's a defensive part of our portfolio. So it's in the low risk bucket.
We talked about not getting excited, but I just got excited about garbage.
Just wait till I tell you about recycling.
So, well, and I think about that for a moment, like, an investor that's deploying money into trying to capture a dividend portfolio. Again, this is not a suitability statement about any one person. So please don't think I'm trying to give suitability advice on this video. But when it comes to looking for a consistent yield, chasing a reasonable dividend simply as a strategy can be very valuable because you're getting that dividend yield, even though the equity value might fluctuate. Is that a fair description?
Yeah, I think the best way to think about it is every year, January 1st, we start out with about 2.5% coming our way. That's not a bad place to begin. So if you're getting basically the value of a GIC day one, and as long as, I think it's important to say, when you're looking at dividends, you want to make sure those dividends never get cut. So step number one is making sure it's durable and stable. And that means that you're starting out with basically a GIC type of return at the start of the year. And then our job from there is to build up that return by finding good companies that are going to continue to compound value and not just pay out the yield to us. So it's dividend plus, and I think it's a great way to frame it.
Oh, guaranteed return. Is that what you said? No, I'm sorry. You just messed
Hey,
up.
that's what the 75-100 is for.
Okay. Got it. Dan, it's such a privilege to be able to chat with you through your thought process and your mechanics. I'm wondering if I can wrap up the conversation with really a two-part or two-pronged question. Why should somebody be excited about investing with Industrial Alliance as a whole? And then specifically, why should a client or a prospective client be excited about trusting you ultimately with their investment dollars?
Well, I appreciate the question. And I think the best way to think about Industrial Alliance is we're a scale company that we have all the resources that we need, but we're small enough that we can still be personal to you and help answer and give you that white glove service that bigger firms tend to forget about. So we're not the little guy proverbially, but we do have enough scale to really help bring the best of both worlds forward. And then as it relates to dividend portfolios, and I'll just use global dividend as an example, is you want to access the world. You want the diversification that the world has to offer, because Canada doesn't have the best luxury goods company. Ferrari's in Italy, Louis Vuitton's in France. We don't have the best semiconductor companies. That sits in Taiwan. That sits in Japan. That sits in the United States. So you want to bring diversification, but you don't want to go too far out the risk spectrum on one end or too defensive on the other. So money is made in the even keel middle, where you stay invested through volatility and you're not worried about Armageddon on one side or challenging the Martians for interstellar domination. So no tree grows to the sky, but it's important not to hide in a bunker either. And I think it's that happy middle that we really like to offer to our clients. So that's really why I think you want to partner with IA and with our team as well.
Well, Dan, on behalf of myself as a current investor and also as an advisor who has a significant number of clients with Industrial Alliance, it's an honor. It's an honor and a privilege to chat with you today. And thanks so much for joining us today on Money Match.
Appreciate it. Good to see you.
All right, all the best.
Take care.